David Kern, Chief Economist at the British Chamber of Commerce, is with me now to discuss his report. Thank you very much for coming to speak to us. So tell me more about why you've raised your forecast for the UK economy.
Two main reasons. First of all, the starting point is much higher. The second quarter of 2010 delivered growth of 1.2%, strong growth for the UK, stronger than America, much stronger even than in the Eurozone, not as strong as in Germany. So the starting point is higher, and there are a number of temporary factors that would increase growth this year. The stimulus, stock building, the weakness of sterling, all these factors in the short term would produce good growth this year. In the second half, not as good as in the second quarter, but nevertheless good growth. Come 2011, VAT goes up to 20%. We have spending cuts that will start kicking in over the year. So looking ahead, we are not forecasting a double-dip recession. We think that it's a risk. The central scenario is that there will not be a double-dip recession. But growth over the next few years, starting in 2011, will be much slower than in the past. So I think we have to be ready to face these risks. And one of the things we have to do is to keep monetary policy as expansionary as possible, which means keeping interest rates at the current level of 0.5%, at least until the second quarter of 2011, and consider, if necessary, increasing quantitative easing if there are clear signs that the economy is going to weaken.
And when you speak about signs of the economy could weaken, interestingly, you have a fairly positive short-term view, a positive view for growth this year and the next, but you've also predicted that the pace of growth will slow sharply over the medium term.
Correct. In fact, for next year, the figures may be a little bit affected by this year, because although in average terms next year is going to be more than we expected, during the year growth declines. So if you look at our position by the end of next year, it shows quite a marked slowdown in activity, which continues in 2012. I repeat, we don't forecast recession, but in 2012 growth will be consistently below 2%.
And you say that the Bank of England should keep interest rates low, perhaps consider expanding quantitative easing, but of course inflation remains above the government's target. So
inflation is a risk. Our view is that the risk of a downturn in the economy in the near term is much higher than the risk of higher inflation. So I think we have to deal initially with the immediate risk, which is that government spending cuts will produce a downturn in the economy. Look what happened in America. I mean, the American situation cannot be ignored. The American economy is so weak. That could have global consequences. So I think in the short term, notwithstanding the inflationary risk, which I acknowledge, we have to deal initially with the risk of a downturn. And I think since we support the spending cuts, I think the spending cuts are risky, but they have to be implemented. So to offset the risk, we have to keep interest rates low.
What about other risks to growth? You mentioned that Britain will do better than the rest of Europe and the US. So how will slowing growth in the US, a two-speed economic recovery in Europe, impact on Britain's economy? Well,
these are very, very serious risks. I mean, what we have now is a roaring German economy. And the German economy has been very useful for us because our manufacturing sector is dependent a lot on the car industry in Germany. So I think that in the short term, these are positive things. But we look further ahead and we see many, many risks. And against these risks, given the fact that we do not support any withdrawal of the policy as far as the fiscal consolidation, we think it's important for the UK to preserve its credit rating, not to do anything on the fiscal side that endangers the credit rating. What we can do in the immediate future, at least for the next 18 months, is to keep monetary policy as expansionary as possible. It's a defense which entails some risk on inflation.
But David, a key part of growth is, of course, business activity, consumer spending, and a key concern right now is that banks are simply not lending enough to businesses. To what extent is that hampering the recovery? Could that be a risk to growth?
Well, again, monetary policy is helpful because it makes the banks stronger, it makes the banks more confident, it makes business more confident. I mean, I agree with you entirely. The recovery can only be driven by business. I mean, what we need is a rebalancing of the economy from government spending and a little bit too much consumer spending towards exports, investment. But in terms of sector, we want a rebalancing from the public sector to the private sector. And I think, again, the only weapon we have at the moment is monetary policy and, equally importantly, a flexible labor market, no regulations. I think that in the next few years, the government must focus on business as the main driver of recovery.
Well, David Kern, Chief Economist at the British Chambers of Commerce, thank you so much for coming in.